Germany's Frankfurt, AP, amid falling Chinese demand and uncertainty over the effects of new Western sanctions against Russia, which might take sizable volumes of oil off the market, the Saudi-led OPEC oil cartel and its allies, including Russia, are set to decide how much oil to sell to the global economy. The 23-nation OPEC Plus coalition is due to convene on Sunday, one day before the start of two measures meant to reduce Moscow's oil profits in retaliation for its conflict in Ukraine. Both the European Union and the Group of 7 democracies have imposed price caps on Russian exports of $60 per barrel and a boycott of the majority of Russian oil, on worries that coronavirus outbreaks and China's tight zero-COVID limits will dampen demand for gasoline in one of the world's main economies. Oil has been trading lower. Lower demand for gasoline and other fuels generated from oil is another possibility raised by worries about recessions in the United States and Europe. Because of this uncertainty, OPEC Plus said in October that output will be reduced by 2 million barrels per day beginning in November. Some speculated that this action would help Russia survive the European embargo. Due to OPEC Plus countries' inability to satisfy their quotas already, the impact was rather limited. On the other hand, the price cap and EU boycott may remove an undetermined quantity of Russian oil from the market, constricting supplies and raising prices. The price cap permits shipping and insurance companies to transfer Russian oil to non-Western countries at or below the threshold in order to prevent a rapid loss of Russian crude. The majority of the world's tanker fleet is insured by G7 or EU-based insurance companies. As Iran and Venezuela have done, Russia would probably try to get around the cap by setting up its own insurance and using the world's shadowy fleet of off-the-books tankers, but analysts say that would be expensive and time-consuming. Gary Peach, an oil markets analyst at Energy Intelligence, predicted that the meeting would be brief and that the alliance would stick to its present output goals. Standing pat makes sensible, especially given that oil is now trading at a favorable price of $87 per barrel, as of earlier Friday. Of course, $98 is preferable, but I believe they currently believe that the market is sufficiently supplied and priced and that there is no need to upset the balance. On the other hand, Clearview Energy Partners analysts anticipate that OPEC Plus will announce a reduction in production of 1 million barrels per day. Since some members are underproducing, a decrease in production of about 580,000 barrels per day is more likely. However, the G7 price cap might lead Russia to retaliate by withdrawing additional oil from the market. According to Kevin Book, another managing director at Clearview, the Saudis are likely to share the Kremlin's goal in dismantling the rising buyers' cartel in the G7. The cap of $60 per barrel is close to the price of Russian oil at the moment, so Moscow could keep selling while firmly rejecting the cap.